Hello, everyone. Thank you for joining us today for the Globe and Mail's Sustainable Finance Summit. I'm Ryan McDonald, Senior Editor at the Globe, and I lead a team of journalists who cover the climate, environment, and resource issues. Before we begin, I'd like to acknowledge the land upon which the Globe and Mail is situated in Toronto is the traditional territory of the Wendat, the Anishinaabe, the Haudenosaunee, the Métis Nation, and the Mississaugas of the Credit First Nation. The Globe organized today's event to talk about sustainable finance and how it's changing in view of the climate change crisis and heightened awareness around these issues. Over the past few years, sustainable finance has quickly gained momentum. We had one finance summit previous to this one, and it's translating into new requirements for businesses, new approaches by investors and financial institutions. So we have a great lineup of speakers to update us on these changes and these challenges. And on behalf of the Globe, I'd like to recognize the supporters of today's events. That includes HSBC Bank Canada, CPA Ontario, IBM, and TD. We're pleased to have representatives from these companies joining us today, along with other experts who are speaking independently. To start us off, we have some brief remarks from Carol Wildling. And she is president and CEO of CPA Ontario. So let's take a look.
Hello, everyone, and thank you for joining us here today. Clearly, the popularity of this event reflects the serious attention sustainable finance is getting from business leaders here in Canada and around the world. I'd like to acknowledge and thank the Globe and Mail for keeping this topic front and center, not just in their news coverage, but also by convening Canada's top thought leaders here today to share their ideas, opinions, and strategies. CPA Ontario shares your view that this topic warrants ongoing and in-depth conversation. The frequency of this and similar events illustrates just how quickly this space is changing. In 2022, there have already been a number of new regulations and frameworks announced. So even for those of us who make it our business to keep up, it can be overwhelming at times. Now, I know we're going to cover a lot of territory with the speakers and the panelists that we have here today, but I'm confident that you will leave here feeling more up to date and armed to advance these topics within your organizations, and maybe feel just a little bit less overwhelmed. Over the last several years, 5 key events have helped shape the direction and discussion around sustainable finance and ESG topics. The 2015 Paris Climate Agreement, the 2017 Me Too movement, the Business Roundtable's 2019 endorsement of stakeholder capitalism, the 2020 COVID pandemic, and of course, the racial justice movement. As business leaders, though, perhaps there is a 6th event. Just 21 days ago, on March 31st, the newly formed International Sustainability Standards Board, or ISSB, chaired by Emmanuel Faber, released 2 exposure drafts or proposed standards that begin to set forth the path for a global baseline of sustainability standards for the capital markets. The sheer magnitude of these events and the very real impact of climate change and discrimination, as examples, have accelerated a fundamental shift in priorities in business and society to the point where I think it's fair to say that companies that don't yet have sustainable finance action plans started are already seriously behind. CPA Ontario is actively engaged in the ESG reporting movement. In fact, the Canadian accounting profession itself played a pivotal role helping to bring the ISSB office to Montreal. The fact that the North American office is located here in Canada is testament to our ability to be a global player and major influencer within the ESG world. Our members are playing an important role, and it is clear that the future of best-in-class ESG and sustainable finance reporting will be data-driven, evidence-based, verifiable, and neutral. We are moving quickly toward the reality that much of ESG corporate reporting will be verified and require assurance reports by third parties. CPAs will play a big role here because our profession has decades of relevant assurance experience. The skills, controls, capabilities, and mindset that have been a core competency of CPAs are now needed for ESG reporting. And while there isn't yet an agreed global standard for non-financial and ESG reporting, we are getting closer and closer because investors and governments are demanding it. Reporting entities are also getting more and clearer direction from other bodies as well. I mentioned ISSB, but earlier in March there were two other important announcements that I'm sure will be discussed here at some point today. On March 15th, the Task Force on Nature-Related Financial Disclosure, or TNFD, released the beta version of its Nature-Related Risk Management and Disclosure Framework. Focusing on natural capital and biodiversity topics, this builds on work from the Task Force on Climate-Related Financial Disclosure, or TCFD, and it has significant support from BlackRock, Bank of America, HSBC, and Moody's, amongst others. Following consultation on the beta, TNFD hopes to release recommendations in the third quarter of next year. We also saw the U.S. Securities and Exchange Commission propose its highly anticipated climate disclosure rule for U.S. publicly traded companies and certain foreign issuers. If approved, the largest companies will need to start disclosing climate-related information filings made in 2024 relating to fiscal years ending in 2023. Now, despite the strong interest and momentum behind sustainable finance, there are still those who see it as virtue signaling and a box-ticking exercise. But I think it's fair to say that ship has sailed. And anyone who thinks they won't be held to account will surely have taken pause at the announcement by UN Secretary General Antonio Guterres on March 31st, appointing former Canadian Minister of Environment and Climate Change, Catherine McKenna, as chair of a new task force to scrutinize the robustness of net zero pledges made by private sector and other non-state entities. Companies will be held to account. I think we can be certain of that. Business has a bigger role than ever in addressing the global challenges in climate and equity. You can all play a leading role in what are some of the most important and pressing opportunities for civil society. Today, your questions will hopefully be addressed. And my hope is that you will leave here with renewed ambition to champion your respective companies' ESG and sustainable finance strategies for the future. Thank you for being a part of this conference and summit, and enjoy the conversations.
Thank you to Carol. You've covered a lot of significant ground there and given us a lot to think about. I'd now like to introduce Sean Cleary. Sean is chair of the Institute for Sustainable Finance with the Smith School of Business at Queen's University. We've got a few minutes to set the stage for some of the discussions that will be happening later today. So Sean, why don't we jump right in? We heard a lot from Carol on what's been happening, and I think it would be great if we could look big picture. From your perspective, what are some of the significant developments over the past year, and can you sort of set the stage at where we are now and where we're headed?
Yes, thanks, Ryan, and thanks for having me here today. So it's hard to pick because there's so much going on. Certainly, sustainable finance has moved into the mainstream over the year, in the last 2 to 3 years. So there's on the investing side, we see over $120 trillion that are committed to the UNPRI principles for responsible investing. So committing to investing sustainably. We also see in the green, social, and sustainable bond market taking off, 1.6 trillion in issues during 2021, which is more than double the 2020 figure and brings the cumulative amount to 4 trillion, whereas it was under 1 trillion in just 2018. So there's a lot going on in the investing side. Relatedly, we see a lot of requests by investors for better climate-related disclosures, and something that Carol mentioned, the Task Force on Climate-Related Financial Disclosures. We see there with somewhere to the tune of 3,000 supporters with 150 trillion, which has come a long way since 2017 as the brainchild and being championed by Mark Carney and Michael Bloomberg. So that's an important area in disclosure that is one of the developing areas today. I'm sure you'll hear lots more about it. In Canada, the recent pilot study by OSFI and the Bank of Canada released the results in January under different warming scenarios and the transitional impact on our economy and several large financial institutions. And of course, all of this is following on the heels of COP26, yet another acronym, but that stands for Convening of the Parties. And Carol mentioned the Paris Agreement 2015, which was an earlier version of that. And leading up to COP26 in Glasgow, Scotland this fall, we saw a number of activities, a number of announcements, and also following up on that, we've seen a lot. And one of the notable ones is something called the Glasgow Financial Alliance for Net Zero, which now represents close to 500 financial institutions across the globe, including several Canadian ones, and manages somewhere to the tune, responsible for somewhere to the tune of $130 trillion. So you can see by these numbers that it's really come into the mainstream. And if I had to pick two areas over the last 3 to 6 months that are gaining a lot of attention, I'd probably mention them briefly already. One is this idea of better climate-related disclosures and also ESG-related disclosures. And also there's been this big push for net zero and plans for achieving them, not just promises to achieve net zero, but what are your plans to get there? And those questions are being asked of both companies and countries.
Yeah, I mean, we we had a that's a very good overview in a very short period of time of all that's happening in the world, and a lot of it is global in nature. In Canada, we've seen a lot of movement, but in Europe and what we've seen from the U.S. SEC, I'm just wondering, do you think we're moving fast enough in this country towards engaging in the stuff that we really need to be doing around sustainable finance?
Yeah, no, that's a good question. And maybe we could look at disclosures as one example. And you mentioned the SEC. So at home, Carol mentioned the formation of the ISSB, the International Sustainable Standards Board. And basically, two of the they're building upon the work of the TCFD, which we've talked about, which emphasizes climate-related disclosures, and also something called another acronym, SASB, which is the Sustainable Accounting Standards Board, which is broader than just climate-related risk and also more coverage on S and G factors, if you will, and also a very industry-specific focus. Now, at home, we saw that the largest pension plans calling for both of these disclosures in November of 2020. They made a similar call to the SEC in June of 2020, I believe. And so we're seeing a lot of pressure from financial institutions at home and abroad. There was a Canadian Securities Administrators consultation period that started in the fall and ended in February regarding implementing mandatory reporting requirements in line with most of the TCFD requirements, not all. And then more recently, the SEC fall with a similar call, but with TCFD, but maybe with some stronger requirements. So we have to think about that as Canadians as one example that we do need to keep up pace with what's going on globally, because we know that capital is very mobile in nature and moves on a global scale, both in and out of all countries. Um, so yeah, I think Canada has we've made a lot of progress, but we still need to keep we've got the building blocks, but we need to up our game a little bit and keep pace with the changes that are going on around us.
That's great to hear on disclosure, and I'm glad you mentioned the mobilization of capital, because I think that's really a big question for a lot of the folks who are probably joining us today. What do you think are some of the biggest challenges towards making that move faster in terms of deploying capital towards these sustainable projects?
Yeah, and I think this is where we're seeing this movement. We're seeing the financial institutions themselves making net zero commitments, and they in turn are turning that glass on their portfolio companies that either they're investing in or lending to, and saying, well, we're not going to get there if the companies that we're investing in are not getting there. So it's actually tied to that other issue I mentioned with the net zero or target commitments. It's all intertwined. And so that's hence the huge demands for better information. And that I think is one of the roadblocks. We need to get disclosures right now are not mandatory, except for in a couple of jurisdictions around the world. So, the fact that we're moving is a positive thing because we need to have those disclosures not only to allocate the capital, but it's also those disclosures will be helpful for the companies themselves, even the non-financial companies, as they try to plan and deal with climate change and identify the risks that they're facing, and also importantly, identify the opportunities that they may face to take advantage of the changing world that we're in.
Is being proactive about those disclosures, that is, in embracing net zero, is that something that you see as one of the major important commitments that businesses and industry can be making and should be focused on right now?
I think that they are very focused on it right now, and they're getting demands from all around, from all of their stakeholders, from their suppliers of capital, and in some instances from the regulators. I think that what we need to push us over the tipping point on that is some regulation that's just forcing the hand of those that are resistant to it. So and it goes part and parcel with making commitments to net zero, or even if it's not net zero, to reduce your emissions. You have to have a starting point, and we want to know where's your intermediate points, where's your ending points, and how can we keep a scorecard on you as you go? Because it's one thing to say it in 2022, but then in 2023, 2025, we want to be able to check on how your progress has. And if you're not disclosing in 2022, it's hard to check on your progress.
Yeah, I'm sure that regulation and those progress reports are going to be some of the broad themes that we touch on today. I'm going to have to leave it there with you, Sean. And I'd just like to say thanks, and it's great to speak with you once again. Thanks for joining us. And I would like to bring in two more guests now, and we're going to talk about how markets are mobilizing around sustainable finance. Joining us today is Zlata Huddleston. She is partner of financial services with IBM Consulting, and Patricia Fletcher, who is CEO of the Responsible Investment Association. We're going to have a chat for about 30 minutes or so. I'm just wondering if we could talk a bit about the vantage point of the Responsible Investment Association, a little bit about who you are and what approaches you're focused on to support sustainable finance in the country.
Well, thank you. And thank you for having us today, Ryan. We really appreciate it. The momentum that we're seeing within the marketplace is just exponential. For those of you who may not be familiar with the RIA, we are the industry association for responsible investment in Canada. And our mandate is really to drive the adoption of responsible investment in Canada's institutional and retail markets. And we do that through a variety of different mechanisms, but primarily through research and market education. But what some may not appreciate is that we actually started in 1990 as the social investment organization. So we've been at this, I like to sort of think of it, long before it was cool. And in many ways, 8 to 10 years ago, this was an incredibly niche topic with some very, very passionate, engaged organizations who really stood behind the belief around what responsible investment can do. And, the momentum that we're seeing now, I think for those that really started with this could see that there was a long-term value tied to focusing on factors such as ESG. And to see that this is the consolidation now. I mean, we are in a peak point of confusion. And I think we all acknowledge that because there is so much momentum happening on all fronts. But in many ways, I mean, I think we regard these as pioneering efforts as the industry starts to coalesce around common standards, common definitions, and literacy increases. And various players at various stages get comfortable with the adoption. To see the mechanisms and the advancements that, are being played out on a federal government level, from a regulatory level, and really just from guidance is incredibly heartening. And from our perspective, don't want to retread where Sean went quite masterfully in terms of talking about all of the various progress on a couple of fronts or a number of fronts. We see some mismatches. You see what's going on within the institutional environment and how that's really driving a lot of progress and momentum around projects and funding. Where we do see some gaps is in the retail side, and not necessarily from a retail investor interest, because our annual survey is seeing that increase dramatically year over year, but the actual information that they're getting or the inquiries that they're getting from advisors is a lot lower than matching what that interest is. So again, in the spirit of guidance that's coming out, IROC's guidance around know your client rules and incorporating ESG and values in that understanding is one that we hope will help to drive this from the retail side and sort of help with that mismatch.
So you were the cool kids from the get-go. That's clear. And you talked a bit about some of the responsibilities of what your organization does in terms of, I guess, educating investors and retail investors and other folks in the field. Where do you see the greatest opportunities for the investment industry in sustainable finance right now?
Well, I will default back a little bit around education, because I do believe in what we are seeing is there are a lot of misperceptions. Responsible investment is an umbrella term for a number of different approaches. But as those of us who are very familiar with it, we often hear about, the one specific approach that deals more with exclusionary approaches, whereas there are a number of different themes that can be deployed. And we do see that happening on the institutional side. I mean, some of the most commonly used RI approaches are both investor engagement, active ownership, and we're seeing that increase dramatically, as well as ESG integration and combination. There's huge opportunities around impact investing. We're going to be able to see that really, I think, deploy quite effectively with a number of different initiatives, and particularly when we start to talk about some of the S factors in ESG as well. And just sort of to come full circle, I think that as, again, the opportunity for the broader public to understand what this means and how they can connect this with their investment portfolio, connect it to what they're experiencing in the real world, and connect it to the impact that they can have in the world or with the organizations that they believe in and want to support. So I think that those are incredible opportunities.
Thanks, Patricia. I think we have Zlata back, if I'm not mistaken. And this may be a good segue for us to, we were talking about opportunities. And I know Zlata, in our pre-conversation, we talked a lot about how technology can serve as a streamlining, a way to streamline sustainable finance. Can you fill us in a little bit on that?
Absolutely. But first, before I start, I would like to just kind of underscore the problem we're really facing right now in relation to sustainable finance. So recall, I think the definition of sustainable finance has been reviewed a few times here today, but just to summarize, it's a practice of channeling public and private funding and investment to sustainable development focused on transition to a climate neutral economy, other socio-environmental objectives through various financial models, products, and markets, just my own summary of sustainable finance. And we've discussed earlier today the 2030 emissions reduction plan with the $9 billion funding in Canadian dollars that's been allocated to it. Also the 2022 federal budget with the $12 billion. But according to one of actually recently published estimates I've seen, to reach net zero by 2050 with current technologies, Canada's public and private sectors would need to spend at least 60 billion Canadian dollars a year. So by 2050, that's 2 trillion in total for Canada. By comparison, if you look at it through all of the sustainable finance related capital commitments that Canadian banks have made publicly so far, they said by 2030 or 2050 in some cases, they committed a total of only 1.3 trillion Canadian dollars. And as somebody here earlier also mentioned, that's not just Canadian problem, that's the huge funding gap is a global problem. So why is it so difficult to close this funding gap? And so what we see from talking to banks on a regular basis is its lack of standardized and reliable data mapping across banks' loan book, things like challenging finding the right data that's scattered across banks in order to support the sustainable finance instruments like sustainable social and green bonds and sustainability linked instruments. Lack of reliable automation that can scale the data mapping. Lack of automated tools to model the reporting. Functionality issues with mapping of the lending book to SDGs or to data discovery dependent on expert knowledge as well as external data that banks don't have to continue with the funding instruments. Things like lack of effective, user-friendly, and self-service dashboards to be transparent about the data in order to streamline certifications, verifications, second-party opinions that are required on sustainable finance instruments. So how are we addressing it between IBM and other technology firms directly with banks that are involved in the sustainable finance instrument funding? I would say the various technology solutions are split up into kind of 2 buckets. The first one is data modeling, analytics, and data visualization. And the second bucket is platforming. With data modeling, what banks need is again faster, cheaper funding process that can be achieved through intelligent automated workflow solutions, and that is to help analyze and model the necessary data faster with more targeted lens. Things like built-in alignment to UN's SDGs and to sustainable green or social bond principles. And that is to streamline the reporting and second-party verification and certification and scoring and rating that's required. Powering it with natural language processing and AI modeling services. And that is for screening for criteria and requirements. And creating a data strategy for verification of the second party opinion processes that would enable mapping of the data inputs with outputs. So all of that would help bank clients to align to requirements on an automated basis and then considerably streamline the financing process. That's the first bucket. The second bucket is platforming that I mentioned, and I'll try to cover it quickly. And that is really favorable ecosystems to process all the heavy activities of that bring investors and funders together. For example, we recently announced a sustainable infrastructure platform where IBM is leading in design and development of the technology platform called Fast Infra. And Fast Infra stands for Finance to Accelerate the Sustainable Transition Infrastructure Initiative that is aimed at developing countries. And this is a global initiative, but it's an example of platforming for sustainable finance purposes. And that is a platform that brings basically funders and investors together with pre-approved projects. So multilateral organizations are involved in the platform. Several global banks are involved in the platform. And it enables pre-approved projects that would be streamlined through the platform, having all that data analytics and data automation already done in the platform before the funding process occurs. We also are involved in, we partner with leading financial institutions around the world in co-creation of just different innovating platforms that are very kind of fit for purpose. So, for example, we recently co-created an ecosystem for agricultural business to enable kind of sustainable outcomes for agricultural borrowers of a large global bank. And that is also AI powered and blockchain based. So automation, streamlining, and AI powered solutions have tremendous capacity to enable the funding process go a lot faster and cheaper.
That is a fascinating and very thorough look at the current landscape. Thank you for that, Zlata. I want to make sure that we get Patricia in here for a bit more conversation, and I'm also conscious of time. So, Patricia, I'd like to look forward to the future a bit, and just maybe you can tell us what sort of developments or emerging trends that you're keeping an eye on at the IRA, or sorry, RIA. Yes.
All right. Yes. Thank you.
Yeah.
One of the key bodies of research that we're going to be doing this year, which I think will inform a lot, is an update to our RI trend survey. That's an incredibly valuable piece of work that we do, and our last study goes back to 2020. We do expect to see, some really interesting outcomes of all the developments that have happened over the last couple of years and be able to quantify that. In terms of, again, other trends that we're seeing, I think the really important trend around the clarification and the common standards as we start to see, and I hate to use more acronyms, but as different sort of classification standards come out for RI that bring more clarity, that's incredibly important. And I think another big area, as I referred to earlier, is the opportunity around impact investing. I think that there is going to be exponential growth in that, and what the nature of the opportunities that we're seeing coming out of things like the ERP and various types of just sort of capital deployment opportunities. I think, and again, extraordinarily important that we'll be talking about later on as the day progresses, is going to be the rising focus on Indigenous perspectives and engagement with and by Indigenous organizations and nations. We need to continue this, and we need to integrate it, and again, make this just table stakes in how we operate in this country.
That's great. Thank you for that. Zlata, same question to you, and we can wrap on this point, and I'll get ready to hand over to Jeff Jones, just considering we've had a bit of a technical snafu. But what are you looking to next? What kind of developments and trends are you keeping an eye on?
I would say I'm looking for more harmonization of in sustainable finance globally on the cross-border basis, to really enable cross-border funding of projects. And I'm looking for, and I hate to say it as a free marketeer, a bit more regulation in sustainable finance. And that goes to the earlier point on responsible investing. There is too much risk of greenwashing, not just in their environmental funding and sustainable finance, but also in social funding. We are familiar with greenwashing concept for for environment, but not enough regulation and not enough attention is being paid to sort of greenwashing in the social context. And that is something I'm looking for.
I think we'll probably need to leave it there as we've lost a bit of time. But I would like to sincerely thank both of you, Zlata and Patricia, for joining us today. And we're going to move on to one of our next discussions. And in that regard, I'd like to sign off and say thank you again to everybody who's still with us, and hand off to my colleague Jeff Jones, who is going to moderate the next discussion.
Well, thanks a lot, Ryan. I appreciate you taking the time to walk us through all of these important issues with regard to sustainable investment. And as Ryan mentioned, I'm Jeff Jones. I'm Sustainable Finance and ESG reporter for the Globe and Mail. And I'm pleased to host a panel of investors and financial pros who will share their approaches to sustainable finance. So let me introduce them. First, we have Jeffrey Sear, managing partner of Raven Indigenous Capital Partners. Also on the panel is Hei-Wan Kong, who is Vice President and Head of Responsible Investing with the Investment Management Corporation of Ontario. And last but not least, joining us is Jay-Ann Guilfoy, President and CEO of Meridian. So thanks all of you for being here today, and let's get right into this. Hei-Wan, let's start with you. How are you as an investor looking at ESG post COP26?
ESG post COP26, again, I think 2021 was a very important year on E. Particularly, the focus really shifted from why we have to address net zero as an institutional investor to how we can play a role in moving towards a net zero economy. I think, again, the recognition that the net zero is imperative because it's the direction of travel where the world needs to move to limit the temperature rise to the Paris Agreement target of 1.5 degree. I think that really has made a significant shift in terms of how we view the ESG in our investment process as well. So again, there are two things going on since COP26 is what institutional investors and all the other stakeholders, what we need to do and what are the key actions we need to play and how does that means to our investment and our portfolio.
You know, it's interesting. I'll just stay with you for a moment, Hei-Wan, because we have seen since that important Glasgow conference a couple of things. One was that there had been a very large global sort of coming together of financial institutions to commit to net zero and put climate considerations front and center in all their investment decisions. But at the same time, there seems to be a trust problem that exists with regard to ESG. I mean, how do you square that circle?
Yeah, I think that's a really important one. So the trust, and I think the previous panel also touched on the greenwashing. So how do we make sure, again, when we think about this long-term ESG risk, systemic risk, how investors can actually incorporate that into our investment process? There are so many ways to do it. There are so many pathways, net zero pathway. The science tells us, again, there are multiple climate scenarios that all the corporates can take. So we really need this multiple actions here. And going back to the question of trust, So how do we make sure that, the commitment actually it's taking place and it's being implemented? So we are seeing different movement here. The regulators we have seen, and also not just regulators in European Union, there is SFDR, again, the acronym, so Sustainable Finance, the directive, really to address what the companies are disclosing, what companies are actually acting on the ESG. Sometimes, they have the ESG commitment or they are selling the ESG products, but what does that mean actually? So we just need to think about the better definition. So I'm absolutely welcoming here that there is movement right now from the sustainability standard point as well, right? So we are seeing international sustainability standard board is coming up with that one single standardized approach to really tackle what are the material ESG issues. Because ESG can again mean different things to different investors, different people, stakeholders. So I think really we have to understand what we are talking about here. What's the definition of sustainable finance? What's the definition when we talk about ESG in an investment or in a corporate world?
Jeff, you come at this from a unique perspective at Raven Indigenous Capital Partners, where you invest in Indigenous projects and businesses that deliver impact for those communities. So tell us how you assess ESG performance as part of this unique investment perspective.
Tanchi, Jeff, and thanks for the opportunity to talk today and invite me in. And just want to say that I'm out in a very small town, rural Ontario, out on the land at a spring camp, practicing my culture on the land. And it's important as we talk about sustainable finance. Raven is an impact investor, as one of your previous panelists said. Impact investing takes a different approach to ESG. The way that I at least view ESG, it's primarily been, at least up until recently, avoidance of non-financial risk by big institutional investors, primarily in the public markets side of things. Being on the private side, what we look for in our investments, investing in Indigenous businesses, really in the innovation sector, to be honest, we look at intention. So when we start doing our screening on businesses, we look first for an Indigenous impact into communities. How do we uplift our communities? Then, we take into account, regular commercial due diligence. And then we start to look at both diversity and inclusion and the environment and climate issues. And so we don't take a strict ESG approach that some other institutions do. What we look at is the core of our work is what's the intention of that business, what's the intention of that enterprise, and how do we see that play out inside the business across all fronts. And this is what I would consider very, very deep due diligence and analysis over each business. We always take a seat on the board in a minority position. So we're actually there to help those businesses actually grow, understanding of the environmental side and climate side, as well as social and governance. I would say we are heavily on the social side, and a little bit less so on environment. But that's how we approach it. It's from an intentionality perspective from these businesses. And I think it's getting to what something Kwan said there is, how deep can you go to understanding what sustainable finance means with each part of your portfolio? And so that's where we find ourselves, very deep in the space. The last thing I'll say for this question is that as an firm, we start out with the place that all things are related. I'm related to you, you're related to me, you're related to Mother Earth. And we want to see a 7-generation principle apply in our investments. We want to look 2 to 3 generations down the road about where that investment and where that company is going to be because that's how we build resiliency in a sustainable finance way. It's a lot of hard work. It's rarely paid for by any investor. It takes us a lot of effort to do it. We're a very small shop compared to some of the folks you're talking to today. But that Indigenous worldview embeds in everything that we do.
It's interesting. More and more you hear a push for the letter I to be added to ESG when it comes to sustainable finance. Some people say it should be part of S. Whatever. I'm not going to get into that debate, but I will say that there is also a real need, I think, and you touched on it a little bit, and that is to understand the impact of um, indigenous culture and indigenous potential in Canada, and bring that more to the mainstream when it comes to sustainable finance.
Yeah. Just a short comment on that. I'm not really a fan of the ESG plus I approach. I don't think it does the Indigenous folks any good as an add on in that. And secondly, more to your point, is I think an Indigenous worldview or Indigenous worldviews, because there's not one, can really help both investors and fund of fund managers get a handle on a different way of looking at investments. I mean, I hope. I have 5 children. I hope and pray we're all thinking about our kids and our great grandkids down the line and what we're leaving to them. And if we do that, we might make different choices. And the tough stuff really hits pay dirt when you're in decision making mode about where to place your capital. And if that influences the way that you make a decision, I'd be a happy camper going forward. It's why we don't really use ESG ourselves, why we apply an intentionality lens to these businesses. Although we do all that hard due diligence to report on ESG. And to be honest, Jeff, what we want to report on and what we are reporting on is the UN Declaration on the Rights of Indigenous Peoples, which was globally agreed to by every state at the UN, that supports Indigenous ways and different ways of approaching the world.
Well, thanks, Jeff. And Jayan, let me move to you. You recently became CEO of Meridian, and prior to that, you worked with Van City, one of the first movers when it came to ESG and reporting. So you propose that we need some creative approaches to mobilize capital for sustainability, for social impact. I'm just wondering if you could sort of walk us through that a little bit.
Well, I think the credit union space in Canada and probably other parts of the world has really been, as Jeff just described, kind of on the ground in terms of, community-based, member-owned organizations that really have always come from a social lens. So we were formed because there were people who couldn't have access to money, and therefore they banded together to figure out, how do I get enough money to help buy a home or help, put my kids through school or whatever, because I was disadvantaged or unheard or unseen in kind of regular financial institutions. So ESG, I think, is at the heart and the root of the cooperative financial sector, of which Meridian is one of the biggest players in Canada. So we're the second largest to Van City. And so we have been practicing this way of thinking in the way we finance our loans, the way we look at investments, the way we work with communities to make them stronger through both donations and giving of our time. So it's sort of already been part of our DNA, and our impact journey. I think has been, quietly doing things for new Canadians, quietly doing things for the Indigenous communities, quietly doing things around helping to create a better world for the future, because it's part of the DNA of the credit union movement.
Well, just expanding on that a little bit, you're a smaller financial institution compared to the big banks. So what niche would you say that you're occupying, or where do you see the biggest opportunities to drive impact?
Yeah, so I'm happy to say that, with Van City, we were one of the investors of Raven Indigenous Capital Partners. So we were early on helping Jeff and his team make sure that they were getting the proper financing to do that. So I think we play, and I think I would have characterized it, we play at Main Street or we play in communities, right? We play at that sort of a level where, maybe it's a $250,000 loan for a small business, could be microfinance for those that need a microfinance loan, all the way up to, probably $100 million. So sort of in that mid market in the market. So that could be anything from, like I said, doing a microfinancing program for entrepreneurs coming out of university or coming from a community that hasn't had the same advantage as others, all the way up to financing of major green infrastructure that's supporting things happening here in Ontario.
Well, hey, Juan, with regard to IMCO, you've got a very large organization dealing with all kinds of different assets for investment. So how do you go about evaluating investments from an ESG standpoint, whether it's a public company, whether it's a direct investment, any of those things?
Yeah. So we really believe that ESG issues impact our investment returns and risk. So ESG issues just should be integrated within our investment process across all asset classes. It doesn't matter whether it's a direct investment or through our external managers, or it's public assets and the private assets. So across all assets, every investment that we make, and again, we have our governance structure that we have to go through the investment committee that we have, and the investment committee, to go there, every investment memo really has to incorporate the proper due diligence, including ESG issues. Um, if you don't integrate ESG, just you're not looking at the full picture of the whole company. So for us, when we do the due diligence on our investment, so for example, we have explicit ESG due diligence questionnaire. We have been really strengthening our due diligence process and the due diligence questionnaire, both for when we every external manager selection, that we are asking our external managers the 5 key explicit ESG issues, including the climate and diversity, and also their ESG integration, both before the investment and the post investment, and then how our managers are thinking about sustainable outcomes and how do they report to us. And same thing that goes to our direct investment. When we are looking at the direct investment, also we apply currently SASB materiality assessment. Now with the new sustainability standards are going to be based on this SASB materiality. So every investment that we are looking at on a direct investment, we are incorporating SASB ESG assessment and also UN Sustainable Development Goal to really think about what are the key products and services this company provides and how they align with SDG. So this assessment has to be incorporated into all of our direct investment.
Anyone can jump in on these, by the way, if you're interested in discussing them. But Jeff, I just wanted to throw it back to you for a moment. You have some funds taking shape with some creative approaches to investment. I'm just wondering if you could talk a little bit about them and how the approach differs from what we would consider traditional investment strategies.
Sure. So we started, and as Jan mentioned, closed our first Indigenous Impact Investment Fund, which I consider a small fund. It's a $25 million fund, and it went very well, and continues to go well. I'm happy to report, even through COVID. We're now raising a $75 million targeted fund to do Indigenous impact investing across Turtle Island, which is all of North America, including Mexico. And we're, if you think of BIPOC investment strategies, if you can use that word, even though I don't like it, we're so far, as we can tell, we're the only I in the BIPOC. So it's an interesting space to be in. So we do what you would call venture capital investment in early growth stage companies in Canada and the United States that have a high sort of Indigenous impact narrative, strong commercial performance, and a genuinely impactful business model that we see as some potential to scale and change the lives of people. The other side of what Raven does, maybe perhaps is more interesting. We just closed a $7.5 million outcomes contract, which is a different type of financing in the impact investment world, to do geothermal on reserve housing, basically to reduce energy bills, bring energy resiliency, Indigenous energy sovereignty into the space, and reduce GHG at the same time. It's a really interesting method of financing, not as known, but provides a really interesting vehicle for impact investors to say, yeah, we want to put our money where our mouth is and really have impact on the ground. And the interesting thing about outcomes financing is you start with the outcome you're trying to achieve right at the outset. You're not measuring it after the fact or post facto in a company that may have existed for a while. You're going into community and say, I'm going to do this. I'm going to do 500 homes and put geothermal in them. That has a huge GHG impact, and it has a huge social impact. And so there's two ways to do it, and we work on both sides of it, both as a fund and as an outcomes financier in that way. And in my opinion, these are really interesting ways to see true impact on the ground. But we're small in that sense. We're a small investment firm trying to do bigger things and hoping to get there.
So who are the investors? Who are the those who are looking for impact through Raven?
Wide variety. You see some institutional investors like Van City, some high net worth individuals, some foundations and family offices, and increasingly institutional investors out of the United States, which are some of our largest investors. And as we raise Fund 2, we don't really know, but I can say that we closed an investment from a Berlin-based German investment firm into our Fund 2 today, which is really exciting because it has caught the attention, at least from the global investment community. I suspect Fund 2 will be a little investors into our fund, and it'll feel like big foundations and big investment funds, and some of the bigger Canadian funds are looking at it as well.
So let me move to the philosophical a little bit, because I know that not all of you would have a direct horse in this race, but it is a big issue that has been sort of simmering in the ESG world for some time, and that is the idea in the investment side of divesting assets versus engaging with management to change their operations to either improve environmental or social performance. So let's start with you, Haywan. Where do you stand on this?
Yeah, I mean, again, this is probably the most frequently asked question. And my belief here is really the binary issue here. It's not mutually exclusive. Investment exit strategy is an integral part of the investment process. So we are engaging during our ownership. We are engaging with our companies or our external managers. Constantly, we engage, encourage, and influence so that we can provide the corporate behavior can improve So engagement is just a fundamental part of the investment process. And then again, thinking about exit, when you realize your value, so whether it's a capital gain or a loss, and that's what you have to consider. How do we really create value from the current investment? So as an institutional investors, again, we, Jeff mentioned that, to sitting on the board, with the exercising our governance rights, and we can help the companies can navigate through this dynamic, constantly changing business landscape, and then we can actually support how the companies can create the value, that sustainable value. So ongoing engagement with the senior management, corporate boards, and also exercising our rights to use our proxy voting as well, which is really critical. So, last year, for example, we included our expectation when we do the proxy voting, for example, that we are now expecting our companies to set their net zero target, and the companies report on task force on climate disclosure as well, so TCFD, and the companies can improve and show that they are actually progress and monitor how they are implementing their climate strategy, the net zero strategy. So really thinking that as a top of the mind for the business leaders, that how the companies can do this better, and then encourage the positive change. And then again, collaboration is absolutely critical, to think about this change that we can make as an investor. So participating in the collaborative engagement with the companies, with the regulators, that is absolutely critical part of this investment process.
Well, JN, I suppose what this boils down to is the question of how can the finance world have the most or be the most effective in creating the types of change that we've been talking about here this afternoon. What do you think about that?
I would tend to agree that I think the opportunity is to be part of that transition. Because I think like investors have influence and investment funds have influence from a board and governance level, a financial institution is providing the capital to help organizations run their business, grow their business, acquire new businesses. We have some areas where we can also embed ESG requirements into the continued relationship and the continued, ability to access capital. So I think our role is to help that transition and influence that transition, because we want to be an inclusive, people-focused financial partner. And so that means working with all kinds of industries as they're moving into that new world. We don't need to divest at the same level that some of our other financial colleagues in the banks would have to, but we can certainly help be part of that transition to a new future.
And Jeff, what about you? I mean, where do you stand on this issue from a philosophical standpoint? Because we hear all sides. I mean, we've heard some great perspectives on this today. There are financial institutions out there that say we will not participate in this fossil fuel industry or that, whatever business line that is sort of against their environmental or social values. So what do you think about that?
Yeah, and I really appreciate the question, and I hope you like the answer. And I realize my connection may be coming in and out a little bit. I would say from a philosophical perspective, if the finance industry itself is finding itself in a place where it So first of all, I believe that the investment space in particular and the global banking industry can drive change. Absolutely, 100%. Now, the second part about that is the set of values which underpin why those financial uh, institutions will do that and how they will go about it. And so I'm fully on board with, divesting initiatives, whether at universities or at other endowments or places that hold funds. I think because if we actually want to hit net zero and COP26 targets and we really have to make change. And as one of your earlier panelists said, we're far from investing enough capital in that. But we can do it in a couple ways. Besides bringing more money in, we can, as Jayann said, we can actually change what's going on the ground as these businesses grow, as they acquire others, as they acquire staff, as they think about their own footprint. So there is a lot of room and I think appetite to do more. We do definitely need people to be brave and bold in the space. That goes for all of the big Canadian banks and financial institutions, for sure. I don't think enough is being done, and I don't think I'm bold in saying that. So I'll just leave it at that from a philosophical perspective.
Well, that's some terrific perspectives from all of you. So, but we're going to have to leave it there. Thanks for joining us today, Haywan, Jeff, and Jayann. And we're going to go now to a colleague of mine, Kelly Kreiderman, who will introduce the next set of panelists. Kelly, over to you.
Hi there. I'm Kelly Kreiderman. I am an Alberta reporter and columnist for the Globe and Mail. And I will be talking about transition finance in this segment and how it might play into the shift to a cleaner economy. And I am joined by Alison Slater, who is the Senior Director of Sustainable Finance with the Global Risk Institute, and also Kevin Ranney, Senior Vice President of Corporate Solutions with Sustainalytics. I've been working on that one. Thank you for being here today, both. And I'm going to jump right into questions because we don't have very much time. And for those, there's all levels of knowledge here. So for those, Alison, who might not be familiar with the idea of transition finance, how do you explain it?
Well, thank you very much. A pleasure to be here. It's been a great day so far, and I'm looking forward to this chat. Transition finance. So when we think about what we need to do to mitigate the worst impacts from climate change, we often think about the transition to green energy, solar, wind, etc. But the reality is the vast majority of our infrastructure in place today and the majority of our economic activity is based on or dependent upon fossil fuels. So what do we do with these legacy infrastructure and systems? So transition finance is all about the money needed to move away from or highly reduce dependency on fossil fuels, reduce emissions coming from our activities today, retrofit buildings. We heard someone on the last panel talking about heat pumps and all that needs to be done in our buildings and housing and industrial buildings, etc. So this, we've seen recently the government put out its 2030 low carbon emissions plan a couple of weeks ago. They followed up with some big ticket items in the budget, the 2022 budget, to fund a lot of this sort of stuff that has to happen. I think the government put a budget together of just over 20 billion, but we're looking at hundreds of billions of dollars needed over the next decade or two in order to get us anywhere near the sorts of emissions reductions targets we need. So this is what we call transition finance. Government can't fund it alone, so there's a lot of interest to figure out how we can activate private finance of all types to get involved in this sector and help move us towards those low emissions retrofits and changes that we need across the board in almost all of our industrial sectors here in Canada and infrastructure.
And transition finance, as I understand it, when it comes to the world of sustainable finance, it's relatively new. Countries are developing their own systems and approaches to transition finance. Kevin, I'm wondering, do you think a global approach is needed, and can you explain more about that?
Sure. Yeah. Thanks, Kelly, and thanks for the opportunity to join this conversation. I'll just start with a note about taxonomies and their place in the world of transition finance. You alluded to sort of different countries developing different approaches, and what is happening in a number of countries is that local taxonomies for green and or transition finance are being developed. Um, just a note on what these taxonomies are for, what role they play. Essentially, they contain standards for the level of sustainability performance required for a given activity or asset, such as a production facility, to be considered aligned with an environmental goal such as net zero by 2050. And so with respect to climate goals, of course, those standards relate most importantly to GHG emissions, and they often include thresholds for carbon intensity of economic activities like steel or cement production, et cetera. And it's important to clarify this because we can think about transition at the level of the whole economy or a sector or a company or in the narrower sense that I've described. And indeed, this is the focus, that this narrower sense is our focus when we assess planned uses of proceeds for a green or transition bond, which is one of the services that Sustainalytics provides. It's important to investors because, at least in the case of use of proceeds, green or transition bonds, it is expenditures at the level of individual activities and assets that they're investing in. So they need to know, are these expenditures contributing to the decarbonization of the activities in question? So to come back to your question about sort of different approaches in different countries, and we consider it a useful exercise for different countries and regions to think about what transition looks like for them, and to look for ways in which they may be able to incorporate, for example, local standards into taxonomies. The European Union taxonomy has done this to a large extent. At the end of the day, though, we want to see alignment across countries and regions with respect to what is green and what really truly supports transition, because climate change is a global issue. Reduction goals, regardless of what level they're at, whether it's company or province or country, they're all intended to support the achievement of international goals. And the other thing, of course, is that financial markets, including green and transition debt markets, are international, and so international investors are looking for credible issuance that sort of credible at the global level.
And it seems so difficult to get to any global agreement on anything that has to do with climate or the like. Is it realistic at this point for there to be some kind of a global agreement on what transition finance and what constitutes it and what goals countries should work toward?
Yeah, I mean that's a great question. I don't think it's realistic or even desirable to have one single standard out there that sort of claims to define green or to define transition. And indeed, there is rich and dialogue across different regions and among different organizations. The European Union has its taxonomy, which is dominant in the international conversation. But an organization called Climate Bonds Initiative also has standards and a taxonomy, and there's been a lot of dialogue there. China has its own taxonomy, and there's been some very fruitful dialogue with the EU, looking for common ground between the two. We at Six, we have our own taxonomy that we use for the purpose of producing our second party opinions, assessing the frameworks for green and transition bonds that issuers come to market with. I think so. So we wouldn't want to see one strict set of rules for everybody, but we do think that it's really important to ground taxonomies in science and in the models that organizations like the IPCC and the International Energy have come up with, and they have produced what we consider to be credible trajectories for the decarbonization of different industries. And there are numerous organizations like Science Based Targets Initiative and Transition Path Initiative that are using those models to produce guidance for the market on what carbon intensity thresholds can be considered to be for any given activity, can be considered to be aligned with broad international climate goals. And so we rely on those if we are looking at an issuance from a steel producer. Now we've got thresholds for the carbon intensity of steel production that we can rely on, and again, to the extent that we can all ground our assessments in the scientific evidence that is available, that it's important to aim to do so.
And I think, the idea of transition, as much as it is important, it will also be fraught, and it could be particularly fraught for a country like Canada that has a huge fossil fuel sector. And I want to ask Alison about that, about how this idea of transition works in practice in Canada.
Yes, early days, and it's true at the UN level, each country has been asked to plan a pathway to net zero. So Canada does have the ability to, be the master of its own script there. But that said, on the global stage, pressure from larger economies and rules set, including cost of carbon, for example, or impacts on trade, carbon border adjustments, etc., or even predominant standards, whether they be voluntary or mandatory standards that start to develop in the global markets, will affect Canada. So we are incentivized to try to find that pathway and try to put that long-term vision out for our energy sector. Unlike other countries, it's a very important sector for our economy, taking up 10 or 12% of our GDP, for example. So it's important that we get this right. I don't think the solutions are really on the table yet, but we're already feeling pressure from international institutional investors, from other governments, to get this right and get our story straight on it. We have some examples from other sectors where we've seen a link up between government, business, and community and stakeholders to forge a path forward, or at least the beginnings of that. Let's say, like the automotive sector, at least here in Ontario, shifting off combustion engines towards an electric vehicle value chain to be developed here in Ontario, and that's investment coming from government, from industry, and stakeholder voices at the table. So, there's some examples for how this might work, and I know dialogues are underway, but we are certainly facing a big challenge because of the relatively high carbon footprint of our energy sector. On the other hand, we have some benefits, especially in the quite sudden change in the geopolitical factors around energy with the invasion of the Ukraine, with strong ESG performance, for example, from our energy sector relative maybe to other countries and regions. So this is not yet set, but this will be the big question of our day in the coming year or two, to kind of see if we can get a linked up approach to figuring out how Canada remains competitive, has that energy security, but does meet the climate goals as well.
And has anybody kind of laid out what transition finance means for the oil and gas sector? Does that does that mean carbon capture, or is there any, defined as of yet pathway for the oil and gas sector in terms of transition?
Well, carbon capture will play a part. Oil, in the end, fossil fuels and oil and gas is here to stay through the longer term transition, not to just at far lower levels than we see it today. So it isn't like the industry will sort of dry up immediately, plus their historical emissions that we need to capture. So we know that carbon capture, utilization, and storage will be a part of the mix. We see very heavy attempts to really cut methane emissions, which is a very potent greenhouse gas, which comes from the extraction of oil and gas. We see Canada leading in that space. That's a possible export as well in terms of technology that we have. So we see some movement. We can't rely only on carbon capture, utilization, and storage. We're going to have to figure out, how to diversify this sector and how to best utilize our resources for the betterment of Canada and Canadians and our business sector, but also that keeps us in line with the carbon emissions goals, and that is going to lead to tough trade-offs and choices.
And Kevin, I want to go back to something you said on the science, and the science being incredibly important to transition finance. How do investors know where to look? How do they make that determination? And is there an example you can point to where there's a real world example of transition finance actually working and actually leading to the outcome that it's supposed to?
So again, there's lots of scientific evidence and modeling available from the IPCC and from the International Energy Agency, and then there are numerous organizations that have attempted to make that available to investors and to companies to sort of simplify things such that companies can clearly define targets for their own decarbonization and to get a sense of what it means for them to be aligned. And then similarly, investors can make that assessment when they're looking at investee companies or their green or transition bonds. And then we similarly, we maintain our own internal taxonomy, which is a set of eligibility criteria against which we assess the credibility of the frameworks of the issuers of green and transition bonds and social bonds as well. But that's another conversation. And so there are ways in which the conclusions of science and scientific modeling are making their way into markets, and so it shows up in there are numerous companies have issued, say steel companies have, as an example, have issued bonds to finance, sometimes incrementally, the decarbonization of their production over time. Sometimes that may happen incrementally, or sometimes they may be able to make a big jump and go straight to methods that are actually using green technologies. So yeah, there are numerous cases of successful transition bonds. I mean, in some cases, there are forward-looking commitments inherent to transition bonds, because most of the time an issuer can't get all the way to green all at once, and so it's a young area, and I don't think it's we don't have that many cases that we can sort of unequivocally assess the success of, but nonetheless, there's numerous cases in the market that I would say are going well.
Right.
Now, having said that, we think that there's tremendous potential for much more transition issuance than we have seen in the market to date. And so we hope that issuers will look at the opportunity here. The word transition is not that positive in the eyes of many issuers, actually. Like that, they like the word green and are not as excited about the word transition. But we really think it can have very positive connotations, and we think that credible transition issuance, there's a lot of demand from investors that are very interested in this space.
Right. And hopefully my image is back. We only have 1 minute left. And that's a really good point that you make on the term transition. It's not necessarily appealing to everybody. I can say from Alberta, it's not necessarily appealing to workers and industries here in a lot of ways. So how do you avoid the pitfalls of this? Very quickly from both of you, what are some pitfalls in transitional investing that need to be avoided as we move forward?
Well, from my end, it's greenwash. We're worried about sort of overstatements, lack of standards, lack of regulation, lack of structure in this market, whether it be sustainable, whether you call it sustainable finance, green finance, transition finance, the whole thing booming. A lot of interest, everybody wanting to, setting big targets, getting involved, right from retail investors right through to institutional investors. And this investment is desperately needed in order for us to get where we need to be. But I just hope that the emergence of standards and norms, agreed upon pathways, science-based, as we've heard, start to help it mature, take shape, firm up, because this is too important of an opportunity for us to miss.
Kevin?
And I would just add, I agree that there is some risk of greenwashing or transition washing in this space. I think it is really important for companies and policymakers to fully embrace the notion of transition, to realize that it is going to be disruptive of many industries. But if we can have the vision to embrace it and to plan for that disruption, to plan for alternatives, to embrace the new technologies, and really look for ways to transition business models.
Okay. Thank you so much, Allison and Kevin, for this really interesting discussion about transition finance. And I'm going to hand it off to my colleague, Rita, now.
Thank you so much, Kelly. Hello, everyone. I am Rita Tritcher. I am a senior business writer and columnist here with the Globe and Mail. And I am very pleased to be moderating our final panel of the day. Throughout the afternoon, we have heard from investors, finance professionals, and sustainable finance experts on how ESG performance is increasingly dictating where capital flows. Now we will have a conversation with corporate leaders who are at the forefront of ESG. They are working to meet new demands from investors as they support their organization's sustainability and social goals. So let us introduce our panel. First, we have Angie Hall, Head of Sustainable Finance in Commercial Banking with HSBC Bank Canada. Next, we have Pauline Alimachandi, who is CFO of Northland Power, Inc. Also joining us is Trevor McLeod, Director of ESG and Public Policy with Enbridge. And last but certainly not least, we have Chantal Desprez, Director of Sustainability with CN. Thank you all for being here today. And I just want to jump right into questions because we have a lot to talk about. I'd like to start with the ESG landscape. And specifically, we know that sustainability and social impact are a much higher priority right now among investors and financial institutions than it has been in previous years. But what specifically would each of you say are the most significant changes to ESG from where you sit? And we're going to go in this order. Pauline first, Trevor, Chantal, and then Angie. So Pauline, over to you.
Yes, thank you. I'm really happy to be part of the conference today. Northland Power has been involved in green and clean energy development and ownership for 30 years. So for us, ESG and particularly the E is not new for our business. I think what's really changed is the amount of interest, attention, and support from capital providers for our business. There's been, I think the biggest change I've seen is just the accountability and interests and requirements from investors and lenders on the initially on the E and the G, and more recently increasing focus on diversity, inclusion, and being a general good corporate citizen as part of the S. And I think access to capital drives all of our businesses. And I think you're seeing capital providers really put more focus and attention on ESG and understanding how much impact they can drive by requiring businesses to improve KPIs related to ESG metrics.
Okay, and Trevor, what about you? What would you say are the most significant changes to ESG?
Yeah, well, I'd certainly agree that the focus from financial institutions, investors has gone up dramatically. I think I would probably, start with ESG itself. I mean, it represents a massive change, right? Where it's really the financialization of sustainability. And in some ways, I think it represents, a response to the changing nature of capitalism itself. And so as we shift from shareholder primacy to stakeholder capitalism, ESG becomes that non-financial framework through which we can measure what's in the best interests of a corporation. So a massive change generally. And, we've seen a lot of things fall out of that, and I'd maybe highlight a couple. We've seen the shift from sort of the voluntary, backward-looking, qualitative reporting that we've typically done in the sustainability space to more forward-looking, target-setting approach, and so that's been a really big change. And those targets, at least in theory, allow investors and others to better measure the non-financial performance of one company against another. Now, lots more room for improvement and change there, but really sets the stage, I think. And the ESG goals that companies are laying out provide the key performance indicators against which financial institutions and others can attach lending terms. So massive change all around. And very much in the spotlight.
What are your views on the changing ESG landscape?
I think echoing a lot of what the other panelists have said, certainly the rise of social has been a key change in the last 12 to 18 months. I would highlight, at HSBC, we've been quite close to sustainability for a number of years and really have the benefit of that global perspective where we've seen real leadership in Europe in particular. But we're really seeing that increase in appetite from customers in the Americas as well, starting to mirror the trends that have been in Europe for quite some time. And that's coming out in a lot of, again, the manners that have been discussed already, whether it's disclosure or improved reporting from our corporate customers. The last trend that I'm really excited about that I'd like to call out is also the permeation of sustainable finance and sustainable conversations as a whole across the economy. And so this is no longer the domain solely of multinational corporations and sovereigns, but our small and medium-sized customers as well are starting to talk about and think about, where they fit within a low-carbon economy.
Okay, Chantal, let's try you again. Okay.
I would echo.
Go ahead.
Sorry about that. I would echo, a lot of what's been said. We've been on this journey of sustainability at CN for about 15 years in a more formal way, and I've been at it for well over a decade. And I'd say it's almost be careful what you wish for, because for many years we were kind of doing our work quietly and talking to maybe some leading kind of fringe investors and fringe companies. And really over the last few years, what we've seen is an increase in stakeholder inquiries and demands across the board. So whether that's lenders, investors, our customers and our employees, and even governments calling on us on this topic across the board. So I would say that's a significant change. Certainly from a regulatory perspective, the recent announcements by the SEC around climate disclosures, I would also bring that up. We do move a lot of plastics, and we have emerging plastics regulations in Canada. So we like to talk a lot about climate change, but really there's been a lot of talk in the last couple of months last couple of years around circular economy and around plastics in particular, and tackling that issue. And then, this experience of the pandemic, I think, has brought home that, we need healthy people to prosper. We need a healthy planet, a healthy environment, and also healthy people. And so the social aspects of sustainability, I think, have emerged, now more than ever, and are kind of playing at the same level as the environmental issues that we've all been talking about, I think, for the last decade or so, particularly climate change. So it's full force, operating on all cylinders with all stakeholders really at the table.
That's a great point. The social aspect is really the sort of thing that we are starting to talk about, even around the kitchen table. Next, I'd like to talk about implementation and execution. So with those changes that you've all outlined in mind, businesses are setting goals and targets such as net zero. Talk to us about how you are executing on those targets and milestones, and the complexity that goes along with that. And so for this one, we're going to start with Pauline.
Sure. So I think firstly, it's great to see a lot of companies moving towards net zero. I think when you look at execution, and certainly when we started sort of our formal global ESG framework a couple years ago, the first step really is to take stock of all your business operations activities, and really bringing, what you sort of call data science around everything your business is doing. Particularly as a large global company, that takes time, is really just, how do you measure emissions? Scope 1, Scope 2. This year, we're going to be incorporating our Scope 3 emissions. So when you set targets, you have to understand your base, your current data, making sure that current data is accurate across multiple different jurisdictions and different facilities around the globe. So I think execution really is about having the right people around the table in your organization. We hired an ESG lead 2 years ago. But I keep reminding everybody it's not her job. We set up a steering committee. We have 15, 20 people across the organization, across various disciplines across the organization, from operations to HR, government relations, public relations, our finance team. It really is a team effort to collaborate around, something as setting a target. I mean, that's just, what seems like an output of a big engine of an initiative. And I think for targets such as net zero, the one thing I would say that it's not just setting the KPIs. I think it's about setting the roadmap and achieving that KPI and ensuring that that's sustainable for your business and not being under pressure to set a target, but having a measured, achievable plan to do that.
Okay, Trevor, you're next. What do you have to tell us about implementation and execution?
First of all, I love the question, right? So much focuses on the targets and rightly so, and how those are developed and the ambition and whatnot. But there's so much work that happens behind the scenes to make sure that you can achieve the targets, right? And so maybe just using net zero as the example, and we have an interim target as well in 2030. But the corporate plumbing has to change completely, right? Like there's a lot of work that needs to happen internally. So we set our targets, our net zero targets, in November of 2020. And through 2021, we've been focused on a wide list of things, and maybe I'll just mention a few of them here. Linking compensation to the ESG goals and building the scorecards to measure business unit and central function performance against that. That's a big lift. Reimagining the capital allocation framework, which is, to align with the targets, both of them. And so all investments now must have a path to net zero, right? So that's obviously not a small undertaking. We issued $3 billion in sustainable finance, which has the impact, I think, of demonstrating both internally and externally that we're serious about achieving the targets. And, our business units have built multi-year plans as to how they're going to get there. And so, a lot there, and then even building a prioritization framework and marginal abatement cost curves to drive efficiency into the process. So there's a lot of work that goes on behind the scenes to make sure you can achieve those targets. And so just really love the question, because sometimes it doesn't get asked.
Okay, and Chantal, what is the wisdom you can impart about execution?
I agree with everything that's been said. Maybe another piece, integration of carbon pricing when we think about long-term capital investments. So I think that was something that wasn't mentioned that I'd add in. And I think, when I think about these longer term targets, whether it's a 2030 or a 2050, I think the credibility comes by breaking down those targets into short, medium, and long-term goals, and to be able to demonstrate the progress towards that target. And I think that's what we're focused on. So we're thinking about 2030, we're thinking about net zero 50, but we're also very focused on, okay, what are we going to deliver this year? Because that's the credibility back to our reporting on an annual basis with our journey or our progress towards this target. So breaking down these quite unusual, really corporate targets that are so far out into short, medium, and long term, and then demonstrating the progress year over year, I think is a way to show credibility in terms of having set these targets. The last point I'll make is, aligning with science as well, right? Climate science is a fairly new kind of consideration for organizations where we're looking externally to some external expertise and science for guidance in terms of how we bring that in and set longer term targets. So I think those are some of the interesting and different aspects in terms of these longer term targets.
Okay, Angie, I also want to hear from you on this. What advice would you share with business leaders who are watching this webcast who might be grappling with some of these same issues around ESG execution?
It's a great question, and it's interesting. Coming from HSBC, we do have 2 net zero commitments, and the first is to be net zero within our own operations, so for our scope 1 and 2 emissions by 2030. But I think more interesting for most folks is our second net zero commitment to be to achieve net zero within our scope 3 emissions, which are our financed emissions by 2050. And so this is the real one. I think a lot of what we've been talking about here are the idea of cross-cutters, where it needs to permeate the entire organization, because the only way for HSBC to achieve net zero in our financed emissions by 2050 is through collaboration with our customers. And really, it's about all of the work that's been spoken about already, quantifying what our baseline is, setting those milestone targets, measuring our progress to ensure that we're able to achieve those milestones that are on the way to net zero in a science-based within a science-based framework. But it's not just the ESG team, and I love what was said earlier, that one VP doesn't own this entire implementation. At the banking side of it, we need all of our relationship managers up to speed, speaking to customers about what sustainability means to them. We need all of our customers bought in, our risk stewards comfortable with how do you assess climate risk at the same quality that you assess credit risk. And so really fundamentally changing the culture and changing what folks consider to be part of their day jobs. And then the most fun part of it is interacting with customers, of course. And I would say within the Canadian context, there's a huge amount of passion and interest from corporate leaders to be a part of that journey to a low carbon economy, to play their part in addressing climate change. And I would really encourage everybody to be taking the steps that have been outlined by the panelists already around setting those goals, really being thoughtful about, what's most material for your business and your sector, because it can be overwhelming. There are so many ESG metrics out there that if you're not focused on what's sort of core for your business, it's easy for the value of the work to really get diluted. So figuring out what's most material, setting those targets, and then really driving the full cultural alignment to ensure that everyone's driving in the same direction.
So many great points there. And one of the things you said that really intrigues me is this idea of how do you assess climate risk the way you assess credit risk. I'm really intrigued by that idea and look forward to kind of seeing more about what the banks do in that way. When we spoke for earlier in our preparation call for this event, Some of you mentioned some real life examples of sustainable finance in action. So I want to dive into that topic a little bit. Chantel, could you tell us about the sustainability linked loan that CN secured last year, including the details about the process and how ESG performance is translating into practical financial benefits?
Absolutely. And it lines up with some of the comments that were made earlier in the opening remarks about how many stakeholders are coming to the table. So we had several discussions with lenders from the banking side. And I think, in the early days of this, which is just, we're only a few years old, really, in terms of sustainability linked loans in North America, the banks were looking to sustainability leaders in particular and organizations that had set, ambitious targets. And that was part of the reason for the discussion, quite frankly, with CN in terms of our track record with our science-based climate target. So the discussions were around linking that loan to that target and to our locomotive fuel efficiency, which is a subcomponent of that decarbonization target. So setting ambitious targets and being able to demonstrate progress towards those targets and having a track record of credibility, I guess, is a good thing in terms of accessing capital in the future or in the present.
Okay, and Angie, I'm hoping that you can offer one or two examples of this as well.
Absolutely. I mean, sustainability linked loans and sustainability linked bonds are by far the most rapidly accelerating product within the sustainable finance suite. I think when we look at the Bloomberg data from 2021, it's clearly the dominant product, particularly in the loan market now. And there's a few sort of technical reasons for that I won't get into. But what's really exciting about these underlying structures is really, again, how they do bring the whole business together. I think previously we've heard from some customers, kind of our key finance contacts over the years, that this isn't really relevant to me. But when that reporting out for your banking partners includes reporting against your sustainability targets, it really starts to shift the conversation within corporates around, who owns this performance and who needs to be involved. I think some of the exciting trends to see are really, again, the diversification into more social KPIs being included as well. So really, I would say almost every structure today still has a kind of headline KPI, I'll call it, that's GHG emissions focused, and usually more environmentally weighted, again, coming back to that idea of materiality and which ESG metrics are most relevant for your business. But seeing an increase in focus in social KPIs, looking at diversity at the board level, diversity throughout the workforce. We saw a transaction that came to market with the KPI specifically speaking to gender pay equity. And so you're really seeing how organizations are embedding their core values into their financing structures and really tying those key ESG priorities to cost of capital.
Gender pay equity is another topic that's near and dear to my heart. Okay. Trevor, let's go back to you to talk a little bit about, real life examples of sustainable finance in action.
Yeah, sure. I think, great points made already, and about embedding core values into your financing. I think that's critical. It's critical both in terms of making sure your targets are real and showing and demonstrating to stakeholders, all of them, right, including employees, how serious you are about achieving those goals. And, maybe I'll back up a bit because I think throughout the day here, we've had some really great conversations about divestment versus engagement, about appropriate finance mechanisms to be used, about the role of fossil fuels in achieving 1.5 degree world. And, I think it's really important. The sustainability linked finance mechanism provides a platform for incumbents, for companies that exist in the energy system that we have today, as try to move toward the future energy systems that are required of us. And so a really great mechanism on not just the environmental side, but as others have said, on the S and the G as well. So we've done $3 billion in sustainable finance in 2021, started with a loan, and that was a $1 billion offering, and sustainability linked loan. And I won't get into too much of the details, but we had and then we went on to 2 sustainability-linked bonds, one in the U.S. and one in Canada, and part of that is we want to do it, of course, but also that the financial institutions are really keen to be driving in this direction, and so happy to be moving there. But we're deliberate about having an E, an S, and a G element to this, and it's been just tremendous in terms of aligning. I think it was Angie who said aligning and embedding the core values of the company with our financing, which is a really powerful message.
Okay, and Pauline, did you want to weigh in?
Sure. I think that, so I've got two main sort of examples on this one. So one is we also did $1 billion sustainability linked loan last year tied to KPIs around increasing renewable energy generation around the world through developing new projects. And the other KPI was around reducing our carbon intensity. So I think all of these products have been and will be beneficial for companies that are proactively, improving, ESG metrics. And you sort of get a pricing benefit if you do achieve those targets, or if you achieve them or exceed them, you get a pricing benefit. And if you don't, then there's, a slight sort of a margin loss. And so, I think products like this really will start to, as they become more and more the norm, will start to differentiate those companies that are excelling on ESG versus companies that, are not doing or not sort of benefiting from products like this. The other thing in general is that, we're looking to source about $8 billion of capital this year for our projects. And initially when Northland was an early entrant into, which is, basically, putting renewable energy in the sea. And when we financed our first project, Gemini in the Netherlands, that was a really tough financing to do. There weren't a lot of players. It was a new technology. And then now when you look at, financing our projects, is how much interest there is and support for renewables, the technology, who we are as a company. But I think this area is one that you've consistently got to keep pioneering. So I like the comment about, choosing an E, an S, and a G metric, and consistently trying to push yourself forward on the next, bettering, your KPIs going forward. Right now, we are in process of financing an offshore wind project in Taiwan, and that's going to be tough. It's going to be one of the first large financings for an offshore wind project in that market. And there are a lot of Canadian banks who are, going to help us do that. And they're also, for a lot of them, it's the first time they're doing anything like this. So you're really seeing people trying to support, push boundaries, and continue to do better. And I think that's great. It'll be great for the economy, great for the environment, and it'll be great to see banks and companies continue to push forward.
This is a really exciting time to be talking about this. Pauline, I just want to stick with you for a moment because we've heard that companies across every sector are on an ESG hiring spree to build up their ESG talent. What has been your experience in that regard, making sure that you have the right people and expertise for ESG?
Sure. So I would say that initially when we sort of created the dedicated group, we've been doing ESG initiatives for a long time, but it was really about creating a dedicated group, accountability and responsibility for ESG across the company. We sourced candidates from the market, and almost all the candidates I remember looking at that time are from a consulting background, and now you see a lot of companies, either hiring or building that talent in-house, which is very much what we're focused on now, is really taking the learnings and having many people in the organization understand ESG and be able to contribute to our objectives as a corporation as a whole. So, I think to start off, it was about hiring the right talent with the right, knowledge and capabilities. And now it's really about building that capability knowledge in-house.
Okay, data is also an important component of this. And Trevor, working with Enbridge, which is obviously quite a big organization, can you tell us about the data that goes into these ESG reports? From a strategic point of view, what do businesses have to do to make sure that they have all the information when and where they need it?
Yeah, data is everything. It's such an enormous task, and it needs to be both accurate and increasingly timely. Like if you think back in terms of, again, I'll maybe stay on the emission side, but if you think back to how data was collected and why, for what purpose in the past, it was largely collected sort of on a time lag for regulatory reporting that happened the following year and later in the year. And now, when you've set goals like this, you need accurate, timely data to inform decisions like in real time. And we're not there yet, but that's the journey that we're on. And so it puts a lot of pressure on environment and air teams and increasingly and Chantal mentioned the SEC and Canadian securities regulators for that matter. And so as this moves into the regulatory realm on a financial timeline, which is early in the year, it really necessitates a real shift in how this is all happening. So a lot of go back into your previous comment about people and skills and whatnot. I think that's the key, and I agree completely with Pauline that this is something that it can't be one little group within the company. This is everybody everywhere that needs to be fluent in ESG and sustainability, and increasingly that's the case. And so that's good. I guess the last thing I'd mention is data governance, and you're really finding the integration of the financial reporting and the finance teams and the sustainability teams is taking off. So I think as Chantal said, you kind of be careful what you wish for, because it's gangbusters these days.
Okay, so we started this panel with a look at what's changed. And we've talked about people and data, but let's now talk about what lies ahead. What do you see coming down the pipe for ESG? What changes or trends are you preparing for next? And Chantal, I'm going to start with you.
I think it was Trevor who mentioned, we are now embarking on a journey of being a little bit more forward thinking with our data. So I'm thinking specifically of TCFD and scenario analysis. So that's kind of a new journey that we're embarking on. And I like to say, we're a railroad. So when you think about climate impacts, physical climate impacts on our network, we're across North America. It's not for the faint of heart. We have a linear network that, covers 21,000 route miles. So just embarking on that journey of scenario analysis and understanding and going into the future rather than backward looking and reporting on, backward looking data. So I'd say, that's a new journey and will keep us busy for quite a while in terms of the reporting. If I think back of our journey and even mine in sustainability, we all started with, well, what is the data? How do we measure this stuff? That's where I started. We didn't even have any baselines. To then year over year, it's a process of really improving the quality of the data that we're putting out there. And when you think about climate disclosures, for example, we all know that we still have work to do around scope 3. So nobody's really kind of there yet in terms of this data. So that's part of the journey as well. It's this forward-looking data, but then what is the quality of the data that we have now, the systems, the accuracy, and then I'm thinking of assurance. Like we're moving towards a world where this data should be at par with financial information, financial data. And to get back to your question and the remarks around people, part of our journey here at CN was for me to bring in somebody from our financial reporting side of the house to help with sustainability disclosures and reporting. So bringing that rigor that we have around financial disclosures in terms of quality, timeliness, assurance into sustainability data, and then even taken it further with the forward-looking kind of scenario analysis that we need to do around TCFD and climate change disclosures.
Okay, Angie, one of the common questions we keep hearing about is, what about smaller enterprises? How do the challenges and the strategies differ for small and medium enterprises?
Absolutely. I think it's also one of those forward-looking trends of where we expect to see ESG moving in the next couple of years here, and really it's already there. And that idea, we have published a report that really looked at, there's an estimated 100 trillion required by 2050 to achieve net zero. And of that 100 trillion, it's estimated that 50 trillion is going to be required by SMEs globally. And so they're a huge part of this conversation. Obviously, within the Canadian economy, it's the bulk of the companies that we have. So there's the real need to be focused on the role of SMEs in a low carbon economy. I think something really interesting is that actually the trends are very consistent with what we're seeing for our larger corporate customers. The recent SEC announcement and what we're expecting from the CSA around disclosures are obviously impacting public side only. But at HSBC, looking at the global context, we're already seeing requirements out of the UK for businesses with turnover greater than 25 million pounds, to have scope 1 and 2 emissions disclosure in the next few years here. So this is a really near-term impact that's coming to SMEs and in a leading market. And therefore, we predict that similar requirements are going to be impacting smaller businesses in the Canadian context in the not too distant future. The other place where we really see a lot of impact for SMEs is really in the supply chain conversation. And so as larger corporates and sovereigns are looking to meet their targets to quantify scope 3, as we've been speaking to, there's a real need for data sharing across the economy and to be able to capture both those baseline emissions as well as the improvements that are being made by businesses of all sizes. So I think you're going to see a lot of collaboration, a lot of focus on disclosure, and really that trend across businesses.
Okay, I want to hear just briefly from Trevor and Pauline as well about what comes next from your perspective. So Trevor, you go first.
Sure. Lots, right? And a number of these things have been mentioned, but so looking ahead to the assurance, the scope 3 stuff for sure, the ongoing guidance and rule setting that's, underway and has long way to go. But I guess the thing I would highlight is, an opportunity to integrate a variety of priorities, right? Too often the E, the S, and the G are sort of separate from one another, and you get separate questions on them. But if you think about, for example, achieving your net zero goals, and think about the role that offsets or nature-based solutions might play, there's also a really powerful Indigenous economic opportunity element in that, and and it aligns nicely with the just transition and just transition principles. And so I think the integration of these concepts is truly important. And right now it seems that they're off on different tracks a little bit. So I think bringing those together would be really important for the next year or two.
I'm really glad that you brought that up. It's such an important topic. Okay, Pauline, just the last word on this. What do you see coming next?
Yeah, I think what we're looking for in terms of what's coming next is how you measure ESG performance versus traditional returns. I think right now you've got a lot of, I'll just focus on the investor group, for example, who are really interested and aligned with investing, in companies that meet, their ESG criteria. They've, a lot of sovereigns, mutual funds, investment funds have dedicated now ESG teams. But when you look at how, these funds are measured at the end of the year, it's still very much on a total return basis, or it's really more on traditional returns. And I think that's going to change. I think it's going to be, how you integrate, ESG performance with returns. I don't think we're quite there yet, but certainly as these non-financial metrics start to become more comparable across companies, there's assurance over them. you are reporting on them the same time as your financial information. I think all of that will come, and I think that will be a really positive change for business, environment, and encourage the right behaviors.
Okay, we just have 1 minute left. So Angie, I'm just going to put this one question to you. It is an audience question. What are the risks of not keeping pace with ESG expectations? I'm hoping you can answer just briefly.
I think the most common tagline we've had is that nobody wants to be the blockbuster of this journey. And so really there are both risks and opportunities within ESG. I think a lack of compliance with regulation is obviously a huge risk for those who fall behind, as well as threats from the opportunity side as your competitors evolve their R&D investments, as technologies advance, for those businesses as well as municipalities and countries that don't invest in the infrastructure required to support the low carbon economy. There are meaningful challenges that could be presented of falling behind. So I'd really encourage all of the business leaders in our audience today to be thinking about, what are those most material ESG considerations within your business? What are the risks that you need to mitigate? But far more importantly, what are the opportunities that are there for you to capture, and how can you drive your business forward?
Thank you so much. There's so much enthusiasm around this topic. I'm sure we're going to have many more events like this in the days ahead. We have to leave it there, unfortunately, because we're out of time. Thank you all for joining us today, Pauline, Trevor, Angie, and Chantal, and for the insights that you brought to the discussion. This brings us to the end of our event. On behalf of the Globe and Mail, I would like to say thank you to all the great speakers that joined us today, and to all of you in the audience for tuning in. And I would also like to thank the supporters of the event, including HSBC, CPA Ontario, IBM, and TV. We will be sending around a link to the recorded webcast over the next couple of weeks. So thank you again, everyone, and have a very good afternoon.